Welcome back. And now Bidvest has reported a flat half-year trading profit. This has headwinds in bulk commodity movements and renewable energy product sales weighed. But new business growth, additional tank capacity and bolt-on acquisitions helped to mitigate the impact. Bidvest CEO Mpumi Madisa joins us now with greater insight on the performance. Thank you so much for your time, Mpumi. Just looking at the reporting period, would you say that growth momentum has slowed, and really how would you characterize this level of flatness or softness?
I think that the results are a function of two pieces of events in the first half of the year. The first one being a really outstanding performance from 4 of our 6 divisions. I think for a trading profit result from our South African services business of about up 16% is excellent. Automotive was up 14%, branded products was up 10%, and our international operations up 9%. I don't think you can discount that. And when I talk about those kinds of numbers, clearly you're seeing good performance coming through them. Then on the other side, there were 3 areas of contraction, 2 of which I had already signaled last year. So firstly, in terms of the freight division, last year I indicated that we don't expect to handle any maize in the first half of the year. That materialized. Secondly, I indicated from a commercial products perspective that the renewable space was still very high and that we would struggle in the first half. That materialized. The only one that we really didn't see coming was Adcock. So we didn't anticipate a reduction in volume and a knock-on effect on margin. So that's the only one that didn't materialize. And between these 3 areas of contraction, that was about 7% on the trading profit line, right? So, if you're contrasting, we've lost 7%, we're flat. Clearly, if the other 3 divisions were even flat, our numbers would be materially different. And I think that you need to contextualize the results in that perspective.
Yeah. And of course, your businesses are also affected by macroeconomic headwinds. Just 4 out of these 6 divisions that actually did post growth in trading profits. What was the difference in these businesses against macroeconomic headwinds?
Yeah, so we saw growth coming out of different areas in our Services South Africa division. Travel volumes remain robust. Our water sales were strong. We had heat waves towards the end of last year, so we did well from that perspective. Our lounges business did well because of travel, and our security businesses also did well off the back of new business. In the rest of the divisions, from an automotive business perspective, we did look at a diversification of those earnings, and that's coming through. So we've added allied services. We're bulking up our independent motor retail business, and I think that mix also contributed to the numbers. In branded products, we did see new business coming through from that perspective as well. So different reasons across the different divisions. But overall, I think they were able to weather the storm. We do take to market basic services and products that are everyday, that are required. We're quite diversified. So if one part of the business isn't doing well, the other parts are able to continue shooting the lights out. And our international operations also delivered. Of course, we did 6 acquisitions in the period, and those also contributed strongly to the numbers.
Well, let's drill into the automotive business. Of course, you talk about the diversification of your earnings, but really noting the kind of structural shifts that we have seen in that industry. Are the levers that you've been able to pull within the business sufficient to really bring in, overperformance, considering the structural changes that we are seeing there?
Yeah, so we've done 3 things this year, and I think we've executed well on strategy this year. So on the first side, on the franchise motor retail side, we've shifted our mix in terms of the OEMs that we represent. We brought on 6 new OEMs, so our mix in terms of dealership is quite different. We will continue representing the traditional OEMs, but we do need a better mix because volumes are moving elsewhere. So we've done that, and we've seen a nice contribution coming through. Secondly, in terms of the independent used vehicle space, we're investing in a business. We're going to build scale. It's performed better in this financial year, but you're going to see a material contribution from that business, probably more towards the latter part of the 2026 financial year into 2027. So at the moment, we're just building capacity and we're building our ability to respond strongly. And then in the allied services space, we've brought in services that are complementary from an order automotive perspective. So we now do vehicle testing, which we didn't do, compliance testing, etc. We now do truck body building, which we didn't do. So we're adding value to the metal and not just selling the metal as is. And we've brought in our insurance businesses that provide vehicle insurance products. And in that mix, in the first half, we have an automotive division that's up 14%. I think that's reflective of the fact that that diversification is really making a positive impact.
All right. Well, in terms of corporate action, what are your priorities in the short to medium term?
Yeah, so I mean, looking forward, we still have some acquisitions in the pipeline. The timing of those is really going to be dependent on regulatory approval. The one big one being Citron, which we announced already. That business is in Canada, it's in the UK, and it's in the US. Regardless of the geopolitics, we haven't changed our view on that business. We still believe that it's a good asset in our hands, and hopefully we'll know within a week or so whether that is successful or not. And then in South Africa, we do have some other smaller acquisitions. Outside of M&A, CapEx investment remains key for us. And in the results today, I also spoke about the fact that there are 3 areas where we're deploying CapEx: further CapEx into our bulk liquid operations in South Africa, CapEx in Namibia in our freight operations, and lastly, CapEx in our water purification and bottling business in South Africa. So that's going to remain a focus. And then the last area, in September 2025 this year, we're going to the international bond market. And so that's going to be a big bond raise for us. Our Eurobond is our biggest debt instrument in the group. And so we're going to market to refresh that process. Those are kind of in the near term, the focuses from a corporate action perspective.
All right. We're looking forward to what you do produce in the second half of the financial year. Thank you so much for your time and for your insights today, Mpumi. That was Mpumi Madisa, CEO for Bidvest.